You are standing on a footpath outside a house you cannot stop thinking about. There are maybe 40 other people on the same strip of concrete. And every single one of you is about to find out that the property market does not price your offer by how much money you have. It prices it by how certain you are that you can actually pay. Those are two completely different things, and only one of them is what you have spent the last 4 years building. That distinction sounds like a technicality. It is the difference between owning that house and standing on the footpath watching somebody else own it, and almost nobody explains it to you before you start looking. It is not in any of the brochures, and no agent will volunteer it. There are 4 levels of buyer in this country, not 4 levels of wealth, 4 levels of certainty, and the two do not line up nearly as neatly as you would expect. And the market treats them completely differently, at every single step. From the moment you walk through the front door on inspection day to the moment somebody's name goes on the contract. So let us go through all 4, using the figures that apply right now. Level 1. You have saved $55,000. Your name is Holly, 29, works in marketing in Newcastle, and that $55,000 took 4 years, a housemate she did not particularly like, no overseas trips, and a car she kept about 3 years longer than she wanted to. On the mean Australian dwelling value, which the Bureau of Statistics puts at just over $1.1 million, $55,000 is a 5% deposit, which sounds like a milestone. It is a milestone, and it is simultaneously the weakest negotiating position available in the entire market, which nobody mentions on the day you hit the number. At 5%, she needs lender's mortgage insurance, which at that level runs 3.5% to 5% of the loan. That is tens of thousands of dollars, and it is almost always capitalized, meaning it gets added onto the loan itself. So she does not just pay the premium. She pays interest on the premium every fortnight for 25 years, and it does not protect her. It protects the lender against her. Her choice of lenders shrinks. Many will not look at 95% at all, which means she is not comparing a market at all. She is taking whichever institution will say yes. And every one of them needs time to assess her, assess the property, and order evaluation. So her offer has to be made subject to finance. That clause is where her position actually weakens. A standard finance clause runs about 14 days, sometimes 21. For 14 days, the person selling that house does not actually know whether they have sold it. And if Holly misses the deadline and says nothing, most contracts treat her silence as a waiver, which locks her in even if the finance later collapses. Level 2. You have $222,000. Your name is Sam. 38, a plumber in Geelong, sold a second work vehicle and cashed in a long service leave payout to get there. And it still took him until 38. 20% changes his mathematics entirely. The mortgage insurance disappears. Not reduced, not discounted. Gone. And the interest rate he is offered drops by roughly 1/3 to 4/10 of a percentage point in the same moment because the lender is now pricing an entirely different level of risk. On a $500,000 loan across 25 years, that one step is worth more than $40,000. Same house, same buyer, same lender, same week of the year. The only thing that changed is which side of one line he was standing on when the application went in. And the pricing on the way there is not smooth. Moving from 89% to 91% can double the insurance premium because once the equity cushion goes, the insurer's exposure jumps. 2% of a deposit and the cost doubles. Nobody explains that curve to you while you are the one saving toward it. But here is what has not changed for Sam. He still needs a lender. So his offer still carries a finance clause. And to the person selling the house, his offer and Holly's offer look far more similar than the $200,000 gap between them would suggest. Both of them come with a condition attached, and a condition is a chance that the sale falls over. Level 3. You have the same deposit as Sam, but you walked in with unconditional approval already in hand. Your name is Bianca. 44, a pharmacist in Perth, and she spent 3 weeks getting her finance fully approved before she walked through a single open home. Most buyers do this in the opposite order, and that ordering is the entire difference. That is not pre-approval. Pre-approval is an indication. Pre-approval is an indication with an expiry date, and lenders withdraw it regularly once they actually look at the property. Unconditional approval means the lender has assessed the property, ordered the valuation, and committed to the money, which means her offer does not need a finance clause at all. And now, she can do the one thing the first two cannot. She can bid at auction. Contracts for properties sold at auction in Australia are unconditional. There is no finance clause, no cooling off in most states, no way out. There is no finance clause, no building and pest condition, and in most states, no cooling off period whatsoever. If you cannot settle, the vendor keeps your deposit and can pursue you for the difference if the property resells for less, which means an auction is not a contest between everyone who wants the house. It is a contest between the people who can afford to be certain. Holly is standing on that footpath with a deposit that took 4 years, structurally unable to raise her hand. Level 4. You are buying with cash. No lender at all. Your name is Ray. 67. Sold an investment property last year, has been sitting on the proceeds in a term deposit, and is in no particular hurry about any of it. Ray does not need approval, an assessment, a valuation, or 14 days. He can offer a settlement period of 30 days or 90, whichever suits the seller better. He can go completely unconditional on the spot, standing in the hallway, with nothing hanging over the contract at all. And this is where the whole thing turns over. Because a seller does not receive 4 offers and rank them by number. They receive 4 offers and rank them by the probability of actually being paid on a date they can plan the rest of their life around. An agent will tell you plainly that in a competitive market, a vendor often prefers an offer with fewer conditions, a shorter settlement, and a faster exchange, which in plain terms means a lower cash offer routinely beats a higher financed one, and the buyer who lost never finds out why. Sit with that. The same $1.1 million does not buy the same house depending on where it came from. Holly's money is worth less per dollar at that table than Ray's money is, before either of them has said a single number out loud. Her dollars carry a condition attached to them, and his do not. And she is the one who has already paid more for it. Higher rate, mortgage insurance she funded and pays interest on, insurance that protects the lender rather than her, and now the weakest offer in the room on top of all of it. Every single disadvantage stacks in the same direction, and they compound each other rather than canceling out. Nobody is cheating. There is no villain in this. A seller preferring certainty is completely rational, and a lender charging more for higher risk is completely rational. Both behaviors are sensible in isolation, and neither party is doing anything they should not. The outcome is still a market that quietly compounds an advantage which already existed, and does it at the exact moment the person with less can least afford it. One honest limitation. Nobody publishes what share of Australian buyers pay cash. Conveyancers see it, agents see it, and it is not collected as national data. It is one of the genuinely unmeasured parts of the Australian housing market. So if anyone quotes you a precise percentage of cash buyers, they are estimating and calling it data. What you can actually do about it depends on your level. If you are Holly, the highest value work is not saving faster. It is closing the certainty gap. Getting unconditional approval rather than pre-approval before you start looking. Shortening the settlement period. Reducing the number of conditions attached to the offer without removing the ones that actually protect you. And if you are anywhere near 80%, the last 2% of a deposit is worth more than the first 10 because it removes the insurance and lowers the rate at the same moment. Tell me in the comments which of the 4 levels you are on and whether anyone ever explained the certainty part to you.